give us the details and the steps he's taken and why build to rent. Tony, thank you for coming on tonight, taking time for your family. Appreciate you.
Absolutely. It's my pleasure. It's my pleasure. Lawrence, anytime I can connect with you and any of these fine folks, I'm happy to do it.
Thank you. I gave you co-host, so if you want to share the screen, you can do that also.
Yeah, so I didn't prepare a presentation. I really wanted to approach this as more of a Q&A type session. Just have a conversation around it, because build to rent at its base level is not really conceptually hard to understand. It's more just understanding the financial aspect of it and the feasibility of it that I can really provide a lot of value to. So, one thing that we focus on especially in commercial multifamily real estate, is we focus on acquisition of assets. We focus on deal performance and where we can provide the greatest returns to investors, ourselves, and provide the biggest impact in the community. Build to rent is really no different. It's the exact same thing, except instead of going vertical, maybe 2-3 stories high, or even mid-rise 4 to 10 stories high, we're building horizontally on the ground, just like you see of subdivision in any of your typical neighborhoods. The other difference is that we really value an asset based on its cost, not its value. So one of the biggest things that we see for all of our multifamily investors is that when we are pursuing a loan instrument or we're looking at a deal, we assume the lending target based on a loan to value perspective. We try to find the value of that asset based on its cash flows. Well, in build to rent, it's a little bit different, because we have to find the value of the asset by how much we can build it for. And that includes costs, reserves, labor, materials, contingencies, and all of the such. So we're really building a multifamily asset, but we're doing it for substantially cheaper for the same value that we would have by acquiring the same multifamily asset. Does that make sense to everyone?
Yep.
Okay. So one thing that we try to focus on is we try to think of everything from the reverse way of doing the full transaction, the full opportunity, the full deal. So I'm a golfer, that's my passion. So one way that we can kind of think about it is we can think of it from the green back to the tee, from our finish line back to our starting point. So what we want to think about is we want to think about the end buyer, that where this asset will go when we're finished with it. And that is one way that we'll think about building it. So in my day job, we still there?
You there?
Are you there? Okay. Yeah, I focus in my day job around institutional acquisitions, where we focus on single family acquisitions, and we also focus on build to rent. So what that's done is it's provided me a lot of insight as to what institutions are looking for. So with legacy acquisitions and COR13 Capital, what we focus on is we focus on building communities that are apartment style homes. They're single family structure or townhomes that are on one single tax map. And the reason we do that is for tax efficiencies. Instead of subdividing them and single platting them each individual home, you put it on one tax map, you're going to cut your property tax obligation down by 20 to 40%, which is really attractive to your retail investors like ourselves and to institutional investors alike. It also makes it favorable for a lending instrument as well. Whereas we can see in multifamily acquisition right now, depending on size, stabilization, age, and some other different variables, we're looking at 50 to 60% loan to value right now. Well, that 50 to 60% loan to value is sometimes still more expensive than the loan to cost structure that we'll get at 75%. So essentially what we're doing is we're able to build the same 150 unit asset, for example, that will have the same value at the end of it, but we're able to do it for 60 to 65% of the actual cost, which makes that gap, that upside, a lot more favorable for investors. So that's really the framework of build to rent. We do it in 3 stages. We do it in the acquisition and development phase, which is essentially just as I said it is. It's you acquire the land, you get it entitled, you want to identify its highest and best use. When you do that, that's going to be the highest return on investment from a value standpoint. Usually we'll see anywhere from 40 to 50% increase in value just by identifying the highest and best use of a piece of property. That we haven't even touched it. All we've done is done the legal framework around what the property is able to be used for. From that point, we'll do the horizontal, the infrastructure. So just like imagine your subdivisions, you see roads, you see lights, you see utilities, all that in place. We put that in place at that point. That's the horizontal phase. You at that point, you'll see typically between the 20 and 30% return on investment from a value standpoint. All of this is unrealized unless someone were to come buy it from us at that point. But that's where you start seeing the large uptick in the value of your dollar that's invested in a build to rent development. And then after the horizontal phase, we'll start building out the vertical in tranches. So we'll do 10 to 15 at each tranche. So if we do 150 units, we'll do 10 tranches potentially at 15 homes per tranche. And as we get each tranche built, we'll start leasing it up upon the commencement of the next tranche. And we'll do that in phases. And just like in a new development of multifamily, we'll have a lot of concessions. Rents will be a little bit lower as we get it built up because there will be construction in the vicinity. It's a brand new home, but we understand that residents, don't want tractors and backhoes getting put in their backyards. So we also take them into account. We don't want to do the first tranche and then the second tranche right behind it. You might want to start in the front and then you go to the back and then you kind of bridge yourself to each other. That way it's a better environment for our residents. And then as you start leasing them up, obviously the rents go up as we get closer and closer to completion. So once we get it to completion, we will get it to stabilization, and our hold period is just very similar to a multifamily asset where we'll look for a 5 to 7 year hold. Typically 5 years is our ideal hold time for the entire project. But then at that point, we start looking for an end buyer, whether it be a retail investor, whether it be an institutional investor, to come in and take it over and work their business plan. And we get out and we move on to the next one. Some of the pros that are involved in build to rent is our break-even point is a lot lower than it is in traditional acquisition of multifamily. We don't need to rent. We don't need to get homes leased up to that 80 to 85% occupancy to be at our break-even stability point. We can have it at 60% average because we're absorbing costs, not taking on just value cost perspective. So that's another attractive piece to why we like this. The other attractive piece is that the demand from end buyers. We know that institutions are really, really hungry for this product. We know that retail investors are really hungry for this product. We know that there is a demand for people to want to live in their own home, but not necessarily take on a 30-year note. We know that there's a demand for people to have community, but they still want to be able to rent and have all the amenities that a multifamily asset can provide. Class A multifamily can provide property management, maintenance, and all the such, as we all know. But there are some risks, and I never want to speak with a group at all about build to rent without identifying risk. I think we do a bad job across the industry of selling deals as really great, but we don't identify risk enough. Build to rent is not going to be something where it cash flows day one. Logically, it can't happen. You have to get assets built. You have to get all the entitlements. You have to get all the vertical built to start cash flowing. That cash flow at the very beginning, once you start having your first tranche of homes built, is really low. But you want to look for cash flow throughout the entire life of the investment. So average starting off 5-6% cash on cash return can turn into 14 to 15%. IRR can go anywhere from 11 all the way up to about 23% IRR when the project is completed. So if you look at it from a total return strategy, the upside in a build to rent development is a lot higher than a lot of your multifamily that we're seeing right now on the acquisition side. And then the demand for new product being Class A, built at a substantially lower cost than acquisition, the demand for stabilized build to rent is through the roof right now, as institutions still are unable to deploy the amount of capital that they have earmarked for this asset class because there's not very many people building it. So all of those things combined, partnering with builders, partnering with lenders, having great relationships and the experience that we have in this space is just why I'm absolutely on fire for it. So at a high level, I mean, that's what it is. I'm happy to answer any questions or provide any information that anyone has.
Thank you, Tony, for that. Thank you, Tony, for that presentation there.
Absolutely.
Now, the con you said will not cash flow day one. Are there other what are other pros and cons?
So the pros to build to rent is obviously the growth of your dollar. The growth of your dollar in a development is going to supersede that of an acquisition. And it's simply a case-by-case basis. But, you know, if you look at a $50 million multifamily acquisition, likely you're going to pay $50 million for it. There's not a lot of bridge for value there. You pay a premium for cash flow day one, for reduced risk day one based on the cash flow value of that asset. From a build to rent perspective, you understand that your dollar is going to grow exponentially as the value of the actual asset grows. So we're taking a piece of dirt that we paid $1 million for and turning all of that into a $50 million asset. So your dollar grows with that. So it's understanding the total return strategy of the entire deal itself, not just the day one or month one strategy.
Okay.
I mean, the cons really are that you're going to be illiquid for a while, and you're not going to see a return for potentially a year to 2 years as we build it. That is just the nature of the beast. That's just the nature of what a development takes. And to be 100% honest and transparent, if you look at every acquisition that we do, if we look at every asset that we invest in, they all had that same type of investment for them to get built as well. So it's just understanding the difference between cost basis investing and value based investing. You're always going to pay more for a value based investment than you will a cost based investment, if that makes sense.
I'm writing down as we're talking.
Yeah, absolutely. Absolutely. Pound me with your questions. I'm happy to take anything.
So, and you talk about this build to rent. What made you? How did you find this build to rent model, and how that happen?
Yeah, so I was in multifamily acquisition investing, just like majority of us are, and I am still pro acquisitions. Like, I don't ever want to have this false sense that I just don't like apartment investing. Build to rent came on because I have a friend of mine who is a developer up in South Dakota, and we got to talking about it. And I asked him one day, "Would you teach me development? Would you teach me how you do this, and why would I do this over just buying?" So over the course of a year, he really started digging into me and feeding me with material and feeding me with knowledge on why development is just such a better upside investment than you can in acquisitions. So the 3 reasons why I went into the development side is, number 1, less competition. Most investors are going to see this as such a risky business that they would rather just stay in the acquisition side. So most people are not going to do what we do. 2, it's going to be a lot cheaper to build a $50 million asset than it is to buy one. If you go look at a 200 unit apartment complex in Orlando, Florida, and they're showing the pricing guidance for around 50 million, you can rest assured no matter where rates are at, you're probably going to pay about 50 million for that asset. Well, understanding exactly how much it costs to build that asset and build a Class A product, knowing that that's around 30 million, was really, really attractive to me. And to be able to sacrifice maybe the cash flow day one for the greater upside in just a couple years, when the terms of a deal anymore are going to be 5 years. Either way, how about them Cowboys? I mean, it's going to be a 5-year hold either way. So, I think that one of the biggest hurdles that I had to overcome was really to understand the total return strategy instead of just looking at it from a month-to-month strategy. And I think what happens to us in multifamily acquisition investing is that we look at it from a day one strategy. We look at it from a month one strategy. We look at it from, what am I going to have in just a year? But we know also, when we read through pitch decks, when we read through webinars, when we listen to sponsors, it's going to be a 5-year hold. So understanding that both of them are going to be a 5-year hold, and both of them are going to be a 5-year hold, I would rather take something that's got a lot more upside, that we can control the expenses. We can partner with a builder that's going to mitigate costs. We can partner with a builder that's going to mitigate risk. We're going to identify the right pieces of land. We've done the market research. We know what we're doing from a cost perspective when it comes to materials and labor. And we know that we can do that project that's going to have the same value for 60% of the cost that it's going to take to acquire that. That brings me just so much joy to be able to know that we can mitigate risk by the partnerships that we have, by the experience that we have, and by the lending opportunities that we can get as well.
Okay. So Rachel has a question for you.
Mm-hmm.
What kind of collateral do the lenders require to cover their risk on BTR?
Mm-hmm.
And how is the capital typically structured to cover construction costs in conjunction with a loan-to-cost loan?
Yep.
And
so I'll answer that.
It's a three-point question. The last question is there a reserve they require?
Yep. So we'll start with the first one, the collateral. Collateral is going to be based to the land, and it's also going to be based to assets that the sponsor has tied as well. So one way that we reduce the risk for the lender is that we come in and we put the money up for the land. So right now in Lafayette, Louisiana, we went and acquired that land before we went over to a lender to talk about the horizontal and vertical. So we own that land outright. So the collateral is the land itself, because we now know the value of it at that point. Then you get it entitled. So the value now of that land has increased by 40 to 50%. So that provides the collateral that a lender is going to be looking for. And then, so what was the second question?
The second question is, how is the capital typically structured to cover construction costs in conjunction with a loan-to-cost loan?
Yep. So typically on a loan-to-cost loan, you're going to get a little bit higher leverage because it is actually going to be a less volume amount. So 75% loan-to-cost loan will be the equivalent to maybe a 55% loan-to-value loan, if you look at it from just a dollar for dollar perspective. How it's stacked up is it'll be done in draws, just like any construction loan is going to be. Once we get to a certain point in the horizontal phase, maybe it'll be our roads and utilities. And then from that point, they'll come and do like a visual inspection or appraisal on it, and then we'll draw the next piece down. One of the biggest things that we do with legacy acquisitions is that we partner with a builder. So that builder, what we do is we waive some of the development fees and the construction fees, and that ties them from an equity standpoint into the deal. So when you go build a home, say Lawrence is going to build a home, you go pay a builder and they have a development fee that's tied into their margin. Well, in theory, nothing stops Tony from coming into that builder and saying, look, I'll pay you 10% on top of what Lawrence is paying you. You leave his house and come build mine. There's nothing stopping him because the material costs are going to be just about the same. So what we do is that we partner with a builder. They want to see the development done. They know exactly what they're doing. They've been institutional developers for a long, long time. We partner with them. They have a lot of their vested interest into the success of our project, because now we haven't just had them waive their equity or have them waive their fee. We've absorbed them into the equity stack. So now they're incentivized just as much as we are to get the project done on time, under budget, provide the best product that we can for our investors and for our residents.
So the last question was, is there a reserve they require?
So we'll have that set aside just in case, something, construction, say lumber goes through the roof, or say concrete goes through the roof. Mm-hmm. The lender is going to want to see a capital reserve bucket of about 10 to 15%, depending on the size of the project, depending on, location of the project. A project in, say, Austin, Texas, is probably going to be deemed by a lender to be a little bit less risky than one in Marietta, Georgia. So it's all about the relationships that we have. And we have a longstanding relationship with Arbor Trust, who is one of the largest debt funds in the nation. And usually what we look for is about a 10 to 15% reserve for contingencies.
Okay.
Yeah.
So now I have another question.
Yeah.
So if you're gonna, would you after you finish building, right? Mm-hmm. As opposed, why would you want to keep it and for the long term?
We would. That's depending on the size, location, and just our overall business plan as a company. We would want to keep them. We would, but we also understand that we don't want to lock up our ability to redeploy capital into another bigger, maybe better projects. Okay. Also, we want to keep investors with us. We want them to ride with us to, they realize their returns. You reach a point in an investment where you have some diminishing returns. You might be cash flowing, but you can put it somewhere and make more, or have something better from a tax perspective, from an income perspective. So, we really look for that 5 to 7 year time, because we also know that institutions will pay a premium for this, or that a retail buyer is wanting to get in on, a build to rent project, but they don't want to build it. I was talking with an investor the other day that they're looking for Class A, almost completed developments to where they can come in, finish them, low CapEx, a lot of concessions, where they can basically finish the project. So we were talking about, what if we created a partnership with, say, Jerry Sanchez wants to come in, he wants to buy build to rent. Well, I come in and we work out an agreement that he puts up a certain amount of bookmark contingency on the front end. So say he raises capital, a year and a half out from when we are looking to sell, and he earmarks that he wants to buy our asset. He likes it, wants to buy it, puts 10% down as the bookmark that he's going to buy it at this value that we have from a yield on cost perspective. Well, now we're helping our retail investors out, the people that we have great relationships with. And now they like our assets, and we just have a working partnership going forward. You can't keep every asset in a build to rent side, because you need to realize some of your cash back to go do more of them. Especially since we don't ever underwrite for refis. So it's not like we're going to underwrite to be able to get capital back out, just because of the way the economy and the way the real estate landscape is right now.
Okay. So there's two more questions here. Rachel asked again, Jerry, I'm going to get you next, Jerry. Rachel asked, the partnership with the GP makes a lot of sense. How much of the equity do they typically look for?
So we usually, it just really depends, because we have 3 deals right now. One of them is going to be 250 units. One of them is only 100 units. But typically we're looking to raise about 25% in equity of the deal. We can go get the lending for about 75% typically. That's the health of our relationship. So to put that in simple terms, we have, a deal that's going to cost us $20 million to build. We only need to raise about 5% of actual capital, and then the contingency on top of that. So we're looking at about $6.5 million that we need to raise to do this entire project. Well, that $20 million project is going to be worth about $40 million, at the end of it. So imagine that gap, that bridge that you're getting from the point of sale that is what investors can look for from a value perspective.
Okay. And Jerry wants to ask the question is, how do you treat investors that come in at different times? And the second question is, are there different tranches and then different returns? And where does it go?
So investors at different times. In what way do you mean, Jerry? What do you mean?
Hey, Jerry, you there? I don't know if he's on the train or not. So
okay. At different times, I will assume that Jerry's talking about different phases in the development, whether it's the acquisition phase, whether it's the horizontal phase or the vertical phase. So typically what we would like to see is we'd like to have our investors come in on the acquisition phase. Why? Is because your dollar is going to go further. If you have, say we have, just the perfect utopia type of market, and refis are all there, you've got low interest rates, and we can build we're going to build a project that costs $20 million. If we can raise $5 million for that asset, and then we can go refi it into the horizontal phase, that imputes some extra value in there that is meat on the bone for investors. And then if you do that into the vertical phase, that's more meat on the bones for investors. And then when you go into stability and you look to potentially sell to an institution, you've gotten extra meat on the bones through all three phases, and then also at the end sale to the institution. So what we'd like to see is we'd like to see investors trust our process to invest with us at the very beginning. Now, we do have capital raises at the horizontal phase because we understand that investors are not always going to come in at that time. There is a lot of perceived inherent risk in that. And I don't at all. I'd rather approach it. But the best time to come into a development as an investor is going to be in the acquisition phase before we've even started going through the actual horizontal architecture, any of that, because that's where you're going to see the largest growth of your money.
And I think that it says, are there different tranches?
So different phases in the development, yes, that we have the acquisition, which is going to be, obviously acquiring the property, engineering, and environmental, where we'll make sure that all the stuff underground is good. You're not sitting on like an old battery plant or something like that. You want to make sure that your architecture is going to be good. Your design is going to be good. And then from there, you now go to the horizontal phase where you lay down your curb and gutter, your streets, your utilities, your electrical. All of that stuff is in place to be able to support the livability of the development. Then you'll have the vertical where you're building houses in different tranches. So to go to Jerry's next question, do we build in different tranches? Yes. So if you have, say, 150 homes, you'll build those in 10 to 15 home tranches. And then once you get all of those done, you'll move to the next tranche, get those started, and then you'll start leasing the first 15 up. And then that's when you just keep on going until you're fully up. Does that make sense, Jerry?
He said thanks. He said thanks. Yes.
Does anyone else have any other questions?
Here you go. Christine?
Yes, any last comments?
Hi. Thanks, Tony, for your time, first and foremost.
Absolutely, Jake.
Always appreciate everything you have to say. So I started a not-for-profit this summer, and I'm looking to, or I will be building and developing houses. It's sort of a build-to-rent model. Again, you can poke holes at it, but I'm going to be building it for low-income and affordable housing and veterans housing. So basically, the way the model works is we have to do two things because the county down there is donating 61 lots of land to us. As long as we meet two requirements, that is having the funds to obviously build the home, even though they have grant programs. They just want to be able to say, like, if those funds aren't available, we're solvent basically.
Right.
That's number one. Number two is identify a builder. We've got part B down. We haven't had part A. So even though it's a not-for-profit, me and my partners have been talking about like first getting the first 5 properties up, because again, they're allotting us the option of acquiring or getting 56 other lots donated. So my question to you is how, I mean, initially I would have to use the bank or like go through like a GoFundMe or something. Do you
Mhm.
see any other way I can accrue capital to first initially start these first 5 lots, which will come in at an average of 350? I've got a very reputable builder down there, and he's willing to build at like even below cost, like at 350. So 350 for 2 duplexes, possibly 3 single-family homes for a 3-2 for 300,000. So should I just raise funds, or like is there anything else you could think of that I could do
I would
to
look
meet the
to,
DLTR model? Yeah.
yeah. So first off, are these homes going to be on one giant tax map number? So if you have, how many homes did you say, Cinto? How many total?
So I have the option of 61 homes, 61
Okay.
lots, but they only allow 5 lots at a time. You can only build 5 at a time. So if I finish if I finish 4, they'll allow me another one at the same time, and then another one and another one until I get the first 5 completed.
Right. Okay. Okay. So what I would do is for the first 5, I would look to just JV with someone that will come in and fund it for you, because
Okay.
trying to syndicate that for just 5 lots essentially, it's going to be kind of tough, and it's going to be a
Right.
lot more effort than the juice probably isn't worth the squeeze at that point for a full syndication. But I would look for someone that is maybe of high net worth to come in and just, fund the amount of capital that you need to get those first 5 done, and then
Right.
basically just roll into the next ones. That's what I would do.
I'm glad that's definitely reassuring, because that's exactly what we're doing. That's the path
absolutely.
we're going.
Absolutely.
Thank you, Tony. Oh, by the way, did you get that golf property in Chicago or something? I know you were looking at something in Chicago.
Yeah, we're close. We're close. We're actually we're getting our operating agreement finalized, and our lender is getting closer to it. That's been a challenge. There's no doubt about it. But you never give up. You just keep on going. When something cash flows that well, you just keep on going.
Well, just remember my advice to you. Just bring a few extra dollars in a briefcase. Illinois is pay to play.
Absolutely. You're right. You're right. But Cinto, I wanted to mention something that you brought up and brought to my mind. That is one significant thing that we do that's a little bit different than other build to rent models.
Yes.
A lot of build to rents are done from they'll just subdivide each lot that one house sits on. That is very different than what we do, and that is done intentionally. We do it on one big tax map number. So if you could imagine, 150 homes sitting on one giant tax parcel. Why do we do that? We do that not only for our own taxes, but for our end buyers' taxes as well. So if Cinto comes in 5-6 years and buys the asset from us, the property taxes that you're still gonna pass them through to your residents, but the property taxes that you'll be liable for on that asset are going to be based on the total value that asset brings in together. Whereas if you were to subdivide each home's lot, that your tax value would be about 30 to 40% higher than what you would being on one tax map.
Oh, so it's consolidated. Yeah. So it's like consolidated. Okay.
It is.
Well, the good thing about us is because it's a not-for-profit, we don't have to worry about the taxes.
Yeah.
So we count. So, but no, that's good to know. Thank you, Tony.
Absolutely.
That's actually something I didn't think about. Thank you.
Absolutely. Absolutely.
Especially when they do that biggest trip.
Anyone else have anything?
Yeah, I do have a question.
Go ahead, Jonathan. Happy to answer it.
Yeah, thank you very much for explaining lies. This is something new to me, but one question I did have, you mentioned that you kind of focus more on like Class A neighborhoods and locations. Is there like a certain criteria that you search for when it comes to find that plot of land that's perfect for your build to rent?
Yeah, that's a great question. So actually, we don't focus necessarily on just Class A areas. We inevitably are going to build a Class A product because it's going to be brand new, if that makes sense. So everything, we put granite countertop shaker cabinets, really, really nice fixtures in the home, really nice appliances. But our 3 deals right now, one of them is in Foley, Alabama, and one's in Broussard, Louisiana. The other one's in Lafayette, Louisiana. So those are not necessarily your Class A core market type, areas. But one thing that I do know is where institutions are looking to go. And I was talking to Lawrence before we all hopped in here that, you can follow about 3 to 5 different key stakeholders or key role players in this industry, and you usually won't be steered wrong. One of those is institutions. And if you find out where institutions are going and parking a lot of their real estate dollars, you're going to be pretty well set up for success. Right now, a lot of your debt funds and your hedge funds and equity supply houses are going into your tertiary markets. Why is that? Because generally speaking, your tertiary markets have a high enough population of renters and a high enough population of moderate income producers that will support a build to rent model. You have a lot of individuals in these areas that don't want to live in apartments. And we have to remember that we're operating a business here. It's not just real estate. Real estate is a business. You have to give consumers what they want. Consumers want to live in their own structure. They want to live in their own space where they don't have someone on all 4 sides of them. And they'll pay a premium for it. They'll pay a premium for the safety of their kids, a gated community, and an area that is deemed to be less population, good jobs, high growth, and safe. And that's where we want to build our build to rents. And that's why billions and billions of dollars is going into these tertiary markets like Foley, Alabama, and the Gulf Coast regions, like Greenville, South Carolina, like a Greensboro, North Carolina. These kind of markets are attracting a lot of debt funds, a lot of institutional capital and hedge funds because of the demographic and the population growth and demand that is there. Does that make sense, Jonathan?
No, that definitely do. I thank you very much for explaining that. And would you mind giving like just a little example of when you mean by institution?
Yeah. So there's 2 types of investors out there in real estate. There's retail investors like us, and then there's institutional capital that you and I pay into. So you at work or you have a car, so you have an auto insurance policy, or you have a health insurance policy. Who you're paying those to are your institutional investors. They take your money that you put in for an auto insurance policy, or you put in an insurance or health insurance policy, and they redeploy that into the real estate market or the alternative assets markets to be able to make a return on the money that you're putting into their company. And that's how they pay your premiums, and that's how they pay your claims. So that's what I mean by institutions. I'm also talking about your hedge funds, your standard debt funds, and they can be of any size. Can be your REITs, can be the Wall Street businesses. Any of those funds up there, your institutional capital.
Gotcha. Thank you very much for explaining that.
Absolutely.
Cinto, go ahead, Cinto.
Yeah, just to follow up to what Tony just said to Jonathan. Jonathan, if you recently, like a month ago, as far as institutions go, JP Morgan started a $1 billion joint venture with a Realty Capital out in California. So like what Tony said, like you follow where the institutions are going. And if they're ready to invest $1 billion, so there's an institution there. And then Blackstone, I mean, they've been doing it. And they're just doubling down even more so because I mean, like everything, right? We're we're becoming the American dream is soon to be rented, at least. So that's pretty much just adding a little bit to that. That's all.
Yeah, I couldn't
No,
agree more.
appreciate that, Santa.
Yeah, you're welcome.
So
Sorry,
anyone-
Tony, what were you saying?
No, I couldn't agree more. I try not to be that one that just fights against where we're going. I try to be that one that realizes where we are going and try to make the best out of that situation and understand from a product and a service perspective of where we're going as well. And that's why I like build to rent also. It's just because of the clientele and the residents of what they want, you know, the millennial generation, what they're looking for. That's perfect for what fits their model of life.
Okay.
Yeah, I'm with I went to the Bruce Lee school. Flow like water, be like water. Just go with it. Great documentary, by the way, if anybody wants to watch it. Bruce.
Does anybody have another question about build to rent? Okay, well then, Tony, I just want to say thank you again for taking the time for your family to come on and explain the pros and cons and giving people a little blueprint to show how to build to rent, the concept of build to rent and what you can go through. And also answer all the questions here.